Well, this is it. This is it. The final Bureau of Labor Statistics jobs report before the election and the Fed meeting. It's a pretty big deal. The election is literally around the corner. I mean, today is November 1st. Welcome to November, first of all. It's crazy. You've got November 5th, now just 4 days away. This is crazy to think that the election that's been coming for 4 years is officially here. It sort of just feels like it's been always coming and coming, and it's finally happening. And, of course, then we've got the Federal Reserve having a meeting just 2 days later. Well, they start their meeting 1 day later on the 6th. They ended on the 7th. So on Thursday, we'll have the Fed press conference to see, are we going to get a 25 BP cut? Are we going to get a 0 cut? Are we going to get a 50? And I'll tell you, if there's one report that is going to dictate what happens, it's probably this one. Now, keep in mind, this report has a lot of uncertainty that goes into it. You've got election hiring, seasonal hiring from Amazon, Spirit Halloween, from, quite frankly, FEMA for disaster relief, for hurricanes. We've got a lot of weirdness in this labor report. So no matter what this report ends up saying, a lot of people are going to scrutinize it one way or the other. With certainty, there is going to be massive scrutinization of this report, no matter which way it goes. But because this is the final jobs report before the election, it could dictate the outcome of the election. If we get a really bad jobs report, and over the next 4 days, the only headlines we have are recessionary, we could end up with a Donald Trump presidency with greater certainty. If we end up getting some kind of blowout jobs report and everything's really good and somehow better than expected, then we could end up with a Harris administration as it potentially dilutes the argument from Donald Trump that the economy is faltering. Now, we'll see how much weight people hang on this Bureau of Labor Statistics report. Who knows? Especially since a lot of people, frankly, think the data is just straight up rigged and purposefully going to be rigged because we have this election coming. But current estimates are that this non-farm payroll report will come in at 100,000. The release is in less than 90 seconds, and I'll be covering it with you. I wouldn't be surprised if it comes in way hotter than expected. The last report blew out expectations. We had a 140,000 report, and we ended up with 254,000. I wouldn't be surprised if we end up coming in 100,000 jobs higher than expected on this one as well. Part of that reason is I don't think you're actually going to see real job weakness until January at this point. I think most companies are going to try to get through this holiday season and do what they can without losing employees. So we'll see. Presently, futures are green. The 10-year Treasury is sitting at around 4.32. We're about to figure out if that is a ceiling or if we're just getting started with yields rising. The NASDAQ sits at about 54 basis points. So what we're going to do is we're going to pull it up, watch the candlesticks. They'll go all over the place. We do have an expiring coupon code today. It is going to be the lead-in to the largest price increase we've had yet. So if you want to join those courses on building your wealth and get all my reallocation trade alerts, go to meetkevin.com. Oh my gosh, it comes in at 12K. It's way low. It's really low. Wow. And the prior report gets revised down to 223 versus 554. Holy smokes. But the unemployment rate somehow stays stable at 4.1. What?
12,000 in non-farm payroll. That is the lightest going back to December of 2020. And partially explained, of course, by storms, hurricanes, and strikes. But but there's more nuance to come. If you look at what the unemployment rate is, that remained at 4.1. So people are going to scratch their heads. Hey, lousy jobs report. Why 4.1?
Yeah.
Because the rate comes from the household survey.
I'm
and the
pulling it
household
up.
survey counts those that are off work, absent,
I'm looking for that report too.
strikes and storms. So they're counted as employed. It remains at 4.1%. Now, let's look at the average hourly earnings month over month. They remain sticky, up 0.4. I would think that's a good thing. We're expecting a 0.3 number.
The seasonally adjusted household report went down. It went down 368,000. So no, it's not that the household report stayed strong. The household report is literally negative 368,000 on the seasonally adjusted table.
That was the original release last month.
The
That
hell?
was downgraded just like the month over month to 3.9. So it's hotter technically, but as expected and prior to revision, it was equal to last month. Now, if you look at the work week, 34.3, it built a little bit more in. It went from 34.2 to 34.3. And last month, a revision, late revision. So it moves up from 0.2 to 0.3. It equals that. Why is that so important? Sometimes less hours worked has a tendency to kind of artificially boost wages. And finally, let's look at the labor force participation rate. 62.7 expected, 62.7 in the rearview mirror, but it comes in participation light, 62.6, which equals where we were in June. To find a lighter number, you have to go to the month before that, to May. And finally,
So the reduction in the participation rate is what skewed this data. And again, you had a revision down of about 31,000 of the prior jobs report, that hot 254. So that gets revised down by like 10%, quite frankly. I am honestly a little befuddled here. How does the unemployment rate stay stable when the household data also went negative? I don't understand yet. I'm working it.
do keep in mind that it closed last week at 424, so it's still up in yield on the week. And at 411, we see that the two-year note has given back quite a bit of ground here. It was at 420 prior to the number. So an outsized effect was expected with the weak number, which everybody predicted. But with all the nuance here, for all the variables that potentially made this jobs light, the market is paying very close attention, trying to get it right in the big picture. Becky and the panel, back to you.
Okay, Rick, stay right there. That's really interesting because you saw the anticipated moves that you might think with equities higher, yields coming down a little bit, just on the idea that the Fed's going to look at this and say, okay, maybe there's potential for cutting again. But you made the right point, Rick, and that point is the household survey shows a different picture. That's the one that is maybe the noise you need to look through from.
Yeah, but I don't think they're paying attention to it. So, okay, we're going to click away from them for a moment. Markets are like a few bips higher on that for the stock market. I am trying to get a little bit more color on the actual report so we can get through it here. So it looks like labor force participation rate dipping is not ideal. So the participation rate is something that the Fed wants to keep up. You know, because if you lose jobs and it's just getting hard for you to find a job, you could end up becoming a discouraged worker, and then, you know, maybe you're just not part of this this at all. This is the first decline in the participation rate since May, down from 62.7% to 62.6%. It is likely the payroll estimate in some industries were affected by hurricanes. However, it's not possible to quantify the effect on the month-over-month change because to isolate. So BLS argues it's not possible to isolate hurricane issues here. So they argue no discernible effect on unemployment rate. Okay, got it. From the hurricanes. From hurricanes. Again, I'm a little confused again by this households report because the seasonally adjusted household data for those employed is down 368,000. Okay, so let's write that down. Seasonally adjusted household report down 368,000. if participation held steady, unemployment rate would have risen. I think that's the move here. Because the participation rate went down, the technical rate didn't go up, but you did lose 368,000 jobs on the households report. Payroll report only up 12,000 versus 100,000 expected. And remember, you had a prior revision down. So prior payroll report revised down 31K. And then let me see if we have a revision on the prior household. Keep hunting here at some of this data. Let's go through the entire summary for a moment. Okay, so unchanged. Temporary help services lost jobs again. Employment declined in manufacturing due to strikes. Fine. Hurricane data. Let's see notes. Long-term unemployed. Number of people not currently in the labor force. Fine. Establishment data. That's this. Was essentially unchanged, up only 12,000. Healthcare added. Government continued to add. Professional and business services and employment and temporary help declined by 49,000. Manufacturing declined by 44,000. Yeah, so that's kind of where you're getting hit a little bit. Let's compare that. So on payrolls, this is quite a bizarre one, honestly. Okay, so establishment survey, we'll call it. Establishment survey says, okay, it says healthcare plus 52K. Then you had government at plus 40K. Then you had manufacturing minus 46K. And then professional / business / temporary help minus 49K. Okay. Construction plus 8. That's low. Okay. Average hourly earnings. Excuse me. Up 0.4%. Okay. Let's see here. Average hourly earnings. Up 0.4%. Average work week little changed, edged down 0.1. Work week down 0.1 hour. And then we had that revision down of the prior. Oops, there we go. Let's see. Non-farm pay. Oh, August was revised down as well. Whoa! Holy crap! Oh no! The August revision is really bad too. So the September payroll report revised down by 31,000. But are you ready for this? This is terrible. The August payroll report revised down from 159K, which was slightly below the trend of 180, to just 78K. Holy smokes. Wow. That's insane. So just 78K in August. How interesting. Which I wonder what was the initial release. I wish I could find that, but I don't have that handy right now. Well, I guess like the initially reported, right? So that would be in let's do really quickly like news.google.com or you know what? We'll do a quick little search. We'll go to Google and we'll type in jobs report, but now what I'm going to do is I'm going to change the date and I'm just going to do a custom date range of, if I want what the August release was, I would just take September 6th, basically. and the jobs report came in at 142,000 was the initial reported. That's interesting, and then it was revised up last month, and now it's revised down even more. Wow. How interesting. That's even weaker than expected. Let's listen in here for a moment.
25 Fed funds futures contract. That's a year from now. And they have restored a bunch of rate cuts. They were playing with this terminal rate that was like 373. I'd be fascinated to think what Joe thinks about this. But they're now down to 357. So they added back another quarter-point rate cut here. So the Fed they're looking through this saying, okay, even when I add back all the jobs, I get that cooling that I was looking for in the labor market.
Do you think, Joe, that this is a situation where the market really is, or the economy really is cooling and cooling pretty rapidly?
You can't have it both ways. You can't say the labor market is great and the Fed should be cutting because inflation's low. We're not back at target. We're massively above where we would be if we'd been growing at 2% for the past 3.5 years. So the likelihood that we're going to get inflation back to 2 if the labor market is robust, I think, is low. So
but
if there's no landing,
do you think it's a robust labor market or not? I mean,
no, I don't think it's a robust labor market, and I argued for 50 basis points back in September because of the data we had at that time, and I think the Fed did the right move. However, I would not be cutting rates next week. The Fed probably will, but the market's been so conditioned by Powell and Fed rhetoric that it doesn't want to back away from it. And to me, that's a problem. I would wait. Inflation's not where it needs to be. The GDP numbers, even if it's done or due to government largesse, which I believe it is still growing at 3%. The likelihood you're going to get back to 2% inflation is less. By the way, the last couple inflation prints have not been great. This notion all of a sudden we're back to 2%. We're not there yet, which is why consumer confidence.
Year over year?
Yes. Year with three.
Yeah, okay, whatever, dude. So listen to this. The last household report was 430,000 on a gain. This one down 368,000. And I mean, so you basically wiped out the household gains of last one. You wiped out the strength of August, and now August turned into a weak report. You still left a little bit in the September report for payrolls, but that could just end up getting revised again. The revisions are getting really dirty now. And then now you're starting with 12,000. This report could get revised negative and end up negative on headline number. So like next month we might look at this and go, oh, it's not a 12,000 gain. It was actually a 20,000 loss or something. So here's my take on this. Okay, I was excited about a potentially strong jobs report here, and some, obviously you can't hang your hat on one thing, right? But some enthusiasm around avoiding a recession. I really don't want there to be a recession. Like I want to be a bull. I really want to be a bull. Like I want to be the little bull that could. But this is a bad report. But this report just sucks, and prior revisions suck too. It's not good. So, what's moving after that? Well, 10-year Treasury yields are down. I mean, that's not a surprise. Then they should go down a lot more. Bitcoin's holding at 70,200, and the bond market indices are basically flat where they were. Like stocks didn't really move on this. Amazon's still down 1.92%. I'm sorry, Apple's still down 1.92%. Amazon's up like 6 or 7%. Amazon is, they're up 6.9%. It's really good. Okay, this is odd. Very, very, very odd. Okay. Response rate tumbled. This is the lowest response rate, though, since 1991. Wow. Response rate was just 47.4%. Lowest response rate since 1991 in January. That's crazy. Okay. Bond market just decided this is a weak report. Yeah, no kidding. Okay. A lot of noise in the numbers. Some people say, yeah, whatever. Everybody was going to say that. We already knew that. Number of workers who couldn't be at work due to bad weather surged. That's understandable. But then again, the household is supposed to pick that up. But that still came in negative 368,000. Odd. Let's see what others are saying. Wow, 2-year treasury is down like 10 basis points. So remember, this is how you get a steepening of the yield curve as well. Like, you don't need the 10-year treasury to go up. You just need the 2 to fall faster. It looks like now we're basically confirming a 25 BP cut. If it wasn't for government jobs, we would have been negative. Holy smokes. Change in private payrolls, headline, negative 28K. Expectation was 70K. Prior revised down 31K. Wow. If not for government, we'd have been negative. Holy smokes. This is scary. That's not good. That's not good at all. Huh. All right. Well, so there you go. There's the unemployment report. This is insane. I'm going to do a little bit more digging, and then we'll go live for the Market Open Live on the Market Open Live channel, but this does not let me go bullish at all. Somebody says, I think he's short. I'm not short. Like, I'm not short stocks. This is crazy. Yeah. 5 sigma miss. Yeah, probably, huh? Yeah, this is not ideal. This does not bode well for a desirable time for buying stocks, in my opinion. I know markets will look at this and go, oh, yay, okay, the Fed's going to give us a bigger rate cut, but this sucks. So, all right, anyway. Thanks so much for being here, and we'll see you on the next one. Come on, join me over in the Market Open live stream. I'll be live for on the Market Open live stream channel in about 30 minutes. Make some coffee, go enjoy, try to digest some numbers, okay? And we'll see y'all soon. Thanks, bye.